Hello traders, welcome back to the channel. I know most of you have a good idea about what liquidity is. You might know it as the fuel that drives the market. You might even know that market moves from one area of liquidity to another. But if your charts look something like this, filled with potential liquidity zones, then it could be a problem. Because first of all, there is a lot of noise and unwanted information in the charts. And secondly, you'll get confused as to which ones to target. So let's fix this. In this video, we will talk about liquidity pools and how to identify high probability liquidity pools. So without wasting any more time, let's get started. If you have followed the first season of the Smart Money course, then you will have a decent understanding about liquidity, that is both external and internal liquidity, and where to find them. Basically, liquidity refers to money available in the market. These are essentially unfilled retail limit orders and stop loss orders waiting to be executed. Now, liquidity pool, as you can imagine, refers to a pool of money or a cluster of limit and stop loss orders set by the retail traders waiting to be executed. Mostly, the retail traders buy or sell at market prices, while the smart money buys below the market price and sells above the market price. In other words, they buy at a discount and sell at premiums. The big institutions try to take advantage of these liquidity pools, but not all liquidity pools are worth their time. As I have mentioned, liquidity pools are associated with money. Some liquidity pools have more money associated with them, while others have less money associated with them. This has to do with where the liquidity pool gets formed, which is none other than the location of the liquidity pool, and it also has to do with the time frame in which the liquidity zone is formed. So, the smart money targets different liquidity pools differently. They attack liquidity pools with more money aggressively, and they use the other liquidity pools with lesser money as a means to get to these larger pool of liquidity. From this, we can understand that a liquidity pool with more money associated with it is a high probability one. So these are the liquidity pools that we must focus on for our trades. Now, the question is, how can you identify such liquidity pools in the chart? But before that, let us try to identify a liquidity pool. The idea is simple. Think from the perspective of a retail trader who uses technical analysis or price action for his trades. Where do you think they will look to place buy or sell orders? And where do you think they will set their stop losses and target orders? You'll be shocked to notice that retail traders mainly trade near important areas of supply and demand like support or resistance, swing highs or swing lows, equal highs or equal lows, from trend lines, etc. They enter into a breakout trade or they enter into a reversal trade near these levels. Either way, they will set their stop loss beyond these supply or demand areas or based upon a candlestick high or low. Now, the target orders, which are also limit orders, are usually placed at the nearest potential demand or supply area where the price can anticipate a resistance. Since a lot of unfilled and unexecuted orders are accumulated near these levels, and since money is associated with these areas, these are liquidity pools. For example, take a look at this impulse swing move. There is a swing high and a swing low formed. Most traders would look to buy above an old high after a breakout, and retailers would look to sell below an old low for a breakout trade. Now, if some traders have already bought from the old lows, anticipating a reversal, then they will most likely put their stop loss below the old low to limit their losses. And on the other hand, if some traders have already sold from an old high, anticipating a reversal, then they will probably put their buy stop orders above the old high. So the old highs have a pool of liquidity resting above them in the form of buy stop loss orders, and there are also the willing buyers with their buy limit orders placed, looking to buy after a breakout above the high. These clusters of buy limit orders and buy stop loss orders placed near the swing high is called buy side liquidity. On the contrary, the old swing lows have a pool of liquidity resting below them in form of sell stop loss orders And there are also willing sellers with their sell limit orders placed, looking to go short after a breakout below the low. These clusters of sell limit orders and sell stop losses accumulated near the swing low is called sell side liquidity. Now, the same concept applies to other areas of liquidity also. Now, let's head back to determining high probability liquidity pools. As I have already mentioned, there are mainly two factors in play. First is the location of the liquidity formation, and the second one is the time frame. In terms of location, a liquidity pool formed near an external structure is high probability. This means major swing highs and lows or equal highs and lows formed on a major structure have high probability liquidity pools near them. In this case, the time frame doesn't matter. If you're analyzing the charts in the 15 minutes time frame, then the liquidity pools formed near the major swing highs and lows are high probability ones, while the liquidity pools formed near the internal structure formations like the equal highs and lows, order blocks, fair value gaps, liquidity voids, etc. are only low probability liquidity pools, which only aids in taking out the major liquidity. These usually act as intermediate stopping points in the market to continue towards these pools of liquidity where more money is accumulated. Now, take a look at this bullish structure marked. You can see that I have marked the higher swing highs and higher swing lows. The region near the swing highs consists of a buy-side liquidity pool. On the opposite, the area near the swing lows consists of a pool of sell-side liquidity. Now, why am I saying an area near the swing high and a low and not exactly saying above the swing high and below the swing low? This is because, according to ICT, liquidity starts from where the body of the swing high or swing low candle ends. So, for this swing high candle, the liquidity pool would start from the end of this body to anywhere above the swing high point. This is the reason why we could see rejections or price pushbacks happen way before the market comes close to the actual swing high level. But mostly the concentration of orders or liquidity or money would be available above the swing high. The same concept applies to the sell side liquidity available near the swing lows. So for this swing low candle, the liquidity pool would start from the end of this candle's body to anywhere below the swing low point. Now, the second factor is the time frame under consideration. A liquidity pool formed in a higher time frame market structure is much more high probability than a liquidity pool formed in a lower time frame structure. This is very self-explanatory. For example, take a look at this 15-minute time frame chart on your left and a 1-minute chart to your right. I have marked the important liquidity pools on both these charts. Now, which out of these two do you think the market will respect more? Quite obviously, the liquidity pools in the 15-minute chart. The reason is quite simple. The liquidity pools in the 15-minute chart is associated with more money behind it, as more traders would be interested in trading these levels. Therefore, they will place more limit orders and stop loss orders. I hope it is clear. But what is more powerful and extremely high probability is a confluence liquidity pool. The idea is simple. So, if a lower time frame liquidity pool overlaps with a higher time frame liquidity pool, then the chances of price returning to absorb this liquidity increases. Not only does the chances of a price visit becomes increasingly high, but also the trade entries can be refined by moving into the lower time frames. Now, the only remaining thing to be understood is how the smart money uses these liquidity pools to their benefit. So, these big institutions use these liquidity pools to fill their large positions. In fact, they use the buy-side liquidity available near the swing highs to sell at higher prices or at a premium. Likewise, they use the sell-side liquidity available near the swing lows to buy at lower prices or at a discount. They use these liquidity pools to manipulate retailers. Now, how they access liquidity and manipulate the retail players is a very interesting topic of discussion. Essentially, there are two ways in which they do this. It could be a sweep of liquidity or a run through liquidity. They will make use of minor liquidity pools to make this happen. So, in the next episodes, We will learn about dealing ranges, external and internal range liquidity, and we will combine all these concepts to understand liquidity sweeps and liquidity runs. So, that is all you need to know about liquidity pools. I hope this video was informative. If you found this video useful, please like this video so that the YouTube algorithm understands that you love this type of content. Comment down your suggestions and questions. Also share this video with your friends and fellow traders. I will see you guys in the next episode. Till then, bye.